Welcome to Taking Stock for the week ending the 7th of November 2025. I'm Matthew Swartz, Senior Portfolio Manager in the Lincoln Managed Investment team, and today I'm joined by our star equity analyst, Charlie Song. How are you doing, Charlie?
Good, thanks, Matt.
As always, the information we share is general in nature and doesn't take into account your personal circumstances. Shares are obviously volatile, and past performance is not a reliable indicator of future returns. So, as we noted in our episode last week, the higher than expected inflation print solidified the RBA's decision to hold rates on Melbourne Cup Day this week. Governor Michelle Bullock and the rest of the Reserve Bank now expect inflation to rest above 3% before easing towards 2.6% by the end of 2027. Now, the bank have made it clear that it still believes some slack remains, but because of the pickup in demand and inflation risks, it is exercising caution.
The pickup in inflation and the RBA's comments that monetary policy is only slightly restricted suggests that further interest rate cuts are probably not on the table in the short to medium term based on current data available.
So the economic picture in the US seems relatively similar, with inflation remaining stickier than hoped, despite signs of a weaker labour market. Meanwhile, the longest ever government shutdown leaves us with very little transparency on the economic front. What we can observe during the US quarterly reporting period, however, does resemble somewhat of a two-tiered economy, where the AI-related companies are producing very strong revenue and earnings growth, whilst cyclicals, be it retailers or stocks tied to the housing market, have largely reported weaker than expected results.
Yeah, and Matt, the best example of this is in the building materials and retail segments. For example, the iShares US Technology ETF has rallied another 3.4% in the past month, continuing its year-to-date gains of 27%. Comparatively, iShares US Home Construction ETF fell 10% in the last month, now 18% below its October 2024 peak.
Yeah, there's certainly some winners and losers out there, isn't there, Charlie? And a few of our star stocks were busy in the acquisition space this week with IVE Group, IGL, Medibank, MPL, and Hansen Technology, HSN, entering agreements to expand their businesses.
Yeah, I covered the IVE Group acquisitions, and they've reached a deal with two relatively small print businesses for $15 million in total consideration, which together would have contributed $3 million in earnings in FY25. So that implies a 5 times price to earnings multiple. Whilst this sounds pretty insignificant against IGL's $460 million market cap, management do note that this provides the company with an entry point into a new geographic market for them, which is Brisbane, and offers reliable income in the medium term, having simultaneously signed a 6-year contract with Domino's.
Yeah, look, it sounds like a pretty good bolt-on acquisition, doesn't it, Charlie? And Medibank Private have agreed to acquire Better Medical for 159 mil. Better Medical is a network of local GP practices that is currently generating about 12 million in operating cash flows annually. Relative to the group's operating profit of about 762 mil, Better Medical is not expected to deliver material earnings revisions.
And then finally, Hansen Technologies announced an acquisition of UK-based Digitalk Group for $66 million. We believe that this is a highly complementary acquisition that will extend the organic growth runway for Hansen. For more information, please read our analyst Jason Yin's comment.
But specifically, Hansen's current billing software capabilities form a fundamental technology layer for mobile virtual network operators such as Digitalk. We think that this acquisition reflects management's widening scope, with Digitalk being an entree of sorts, as the team at Hansen start extending their current capabilities beyond billing and into customer relationship management.
Yes, and Digitalk will add approximately $6.6 million in cash operating income, or around a 5% uplift in Hansen's earnings.
And turning our attention to the banking majors, Westpac and National Bank both released their full year results. On paper, they look fairly similar, both offering fully franked dividend yields of about 4%, but their business models and profit drivers tell two very different tales, don't they, Charlie?
Yeah, they do. Westpac is Australia's second largest bank and generates more revenue from housing mortgages than the other banks. It reported a cash profit of $6.97 billion, down 2% on last year, even though revenue rose 3%. The decline came down to high expenses, particularly technology investment and restructuring, which outweighed gains in business and institutional lending.
Still, Westpac's fundamentals do remain reasonably solid. Its capital ratio climbed to 12.5%, well above regulatory minimums. And credit quality does remain excellent, with bad debts being a paltry 4 to 5 basis points of total loans. Deposit growth has remained strong across all segments, and the final dividend of 77 cents took the full year payout to $1.53 per share, up 1% on FY24 and maintaining a steady 76% payout ratio.
Yeah, we saw investors react pretty well to the company's result, didn't we, last week, Matt? And I think that was because both the asset quality and lending growth were better than expected. And notably, Westpac CEO Anthony Miller provided a pretty positive take on the economy, with expectation that GDP and real household incomes improve over the next 6 to 12 months.
Well, we all hope that comes to fruition, don't we, Charlie? But turning to the National Bank, it reported flat cash earnings of about 7.09 bill, broadly in line with market expectations. Revenue rose around 3%, supported by stronger business lending and treasury income, but higher costs and a 14% rise in bad debts did offset that growth.
NAB declared a final dividend of 85 cents, bringing the full year payout unchanged from last year and reflecting a 75% payout ratio. Overall, NAB remains well capitalized through cost discipline, and credit quality will be key watch points heading into FY26. Like Westpac, NAB provided positive commentary around economic conditions, with the company noting that business conditions and confidence are increasing.
So I guess while both banks continue to deliver dependable income, their focus areas set them apart. Westpac offers more defensive stability through the housing cycle, supported by strong capital and lower bad debts, but it's also vulnerable to high expenses from its transformation program. Meanwhile, the NAB provides higher margin exposure to business credit growth, appealing in an expanding economy, but more sensitive if conditions do soften.
That's right. And turning to the corporate calendar, next week, ANZ will release its full year results, marking the end of the major bank reporting season. And Aristocrat Leisure is scheduled to report on the 12th of November, which will provide some fresh insight into the growth of their digital gaming platforms. In Under the Microscope this week, we're taking a closer look at Steadfast Group, Australia's largest insurance broker network. The company's share price has fallen sharply following governance concerns and a softer trading update.
Yeah, pretty disappointing, Charlie. Managing Director and CEO Robert Kelly has departed, at least temporarily, pending an investigation into allegations of workplace misconduct. Now, a couple of days later, Steadfast also announced slightly weaker near-term outlook for its insurance premium growth, which did compile, I guess, the bad news and the share price decline. Whilst the board has already commenced a formal CEO succession process, the governance issues do pose some degree of uncertainty, unfortunately. Now, Tim Matheson, the CEO of the Australasian Broking Division, has been appointed as acting CEO in the interim.
Investors should know that Steadfast left its FY26 NPAT, or net profit after tax, guidance of $365 to $375 million unchanged despite all of this going on. So that does suggest that management still expect organic growth to support an earnings uplift in FY26.
And we think that the share price reaction is somewhat of an overreaction, with it being down 20% since the trading halt. Steadfast still has a diversified earnings base, resilient margins, and strong cash flow generation, characteristics that typically underpin stability through market volatility.
For that reason, we've decided to retain SEF in both our Star Growth and Star Income portfolios for now. However, we'll continue to monitor the investigation outcome, governance developments, and premium rate trends closely, and reassess if the risk profile materially changes.
So for question of the week, we're going to do a deeper dive into Golden Rule 2. Now, for resources stocks, we do refer to the trend in return on invested capital, but for financials and industrials, we do look at return on equity. So let's explore what the differences are, Charlie.
Yeah, and to answer that question, Matt, you need to understand what invested capital means. It's the assets that a business uses to run the business. Essentially, it's your operating assets minus liabilities that don't earn interest, such as accounts payable. This is called your net working capital, plus property and equipment, and goodwill and intangibles.
And the return on invested capital is calculated as the net operating profit generated by this invested capital. It gives a good indication of a company's actual capacity to generate returns through the utilization of its productive assets. Hence, it is useful for resources companies, which tend to be capital intensive and have significant future capital expenditure.
Yeah, and a return on equity captures the return from the company's equity base, which is total assets minus liabilities. In other words, how efficient shareholder capital is being used to generate profits. It is useful for financials and industrials because these businesses tend to provide services and are less capital intensive.
But ROE does have some limitations. For example, it can be inflated by debt. Hence, it's important to understand the financial health of a business in combination with assessing the return on equity. It also tends to be weighed down a bit by businesses that have high capital requirements. All right, so that's all we have time for today. Thank you so much for joining us, Charlie.
Thanks, Matt. Great to be here.
And if you do have any questions on any of the stocks facing significant volatility, please feel free to call our analyst team. Otherwise, come along to our next session for Lincoln Live on Monday morning. And before we do wrap up, a quick reminder, if you have any friends or family who could benefit from Stock Doctor, please share our link with them. Our growth comes from members just like you, and we truly appreciate your continued support. So until next time, take care and have a happy, healthy, and prosperous week ahead.